Home loan interest rates look set to rise this year, with the RBA today coming out and abandoning their language of patience. They've actually started to say that cash rates could potentially move depending on what's going to happen with the labor market and inflation. If you've been out and about and seen the Bowser, prices are up. It's pretty hard to know this is going to happen. The RBA is progressively clearing the way for a rate hike sometime in the months ahead. AMP's chief economist is saying, even a couple of economists are actually saying as much as it could be as many as 3 rate rises this year. Nathan, we've seen it today with a couple of banks announcing some massive changes in interest rates. I guess, like, starting with what's on the ground, what are you seeing out there?
Well, we're seeing a huge shift in the fixed rate market. So, for example, as of today, we're getting fixed rates from about that 3.18% for a 2-year fixed. From tomorrow, the banks actually emailed us and said, we're increasing our fixed rate to 3.78%. And this has been a common trend since really December last year. We're getting fixed rates as low as 1.89%. And nearly every second week, we're getting emails from banks saying they're increasing their fixed rate. So it has been a troubling trend. And the market is definitely factoring in the increased rates that are on the horizon in the fixed rate. It's actually starting to make sense not to do a fixed rate in many circumstances, because the difference between what you get on a variable is so significant to what the fixed rates are on offer.
Yeah, I think it's going to depend on your situation. Like, even by some of the banks' forecasts, they're saying that the cash rate could be at least almost like 1% higher in the next 12 months. And the next 24 months, it could be as much as 2% higher. So yeah, definitely, Nathan, I guess to your point, it's going to depend on your situation. If you're concerned about stability, if you're worried more about the downside of interest rates increasing. So if that extra 0.5% is going to make a pretty big difference to your budget and going to cause you stress, fixed rates still make sense. I think, no one really has a crystal ball financially. You don't know what's going to happen with the rates, but at least you can sort of sleep easy at night knowing that, hey, my repayment's going to be X for the next 2 years, and that's fine. But on the inverse, yeah, like, definitely, if you're the kind of person that might have a lot of money in budget, you might have a big deposit, and you're comfortable to take that risk on the interest rates, then you might leave your rate or your loan as variable and sort of risk that. There's pros and cons, I guess, for each approach. What are you typically seeing, Nathan? What sort of person sort of looking at sort of a variable rate facility and going down that way and risking a little bit, or who's looking kind of more fixed at the moment?
Yeah, definitely. We do see a lot of first homeowners that have that preference towards a fixed rate, only because it does give that stability in repayments. You know exactly what you're after. At the moment, from what we've seen with this new interest rate rise, fixed rates coming in the high 3% and variables coming in the low to mid 2s, there is that gap now. It's becoming sort of 1.5%, where people are actually asking themselves, is it worthwhile to fix, and how high are rates actually going to go? So it's a $1 million question. I guess no one's really got their crystal ball. As you said earlier, Jayden, if you're looking for that stability, fixed rates can still make a lot of sense. They are starting to become harder and harder to justify just because of that differential. On the flip side, if you've got a lot of cash flow, you're a little bit more bullish on the market. You're not too concerned if rates go up. An extra $50 a month out of your budget isn't going to concern you. Well, that's where we're seeing a lot of people take up the variable side of things.
Yeah, even kind of looking at like those NAB forecasts that I'd sort of put through here, the thing to remember too is that banks, I guess, when they start increasing rates, won't necessarily just follow the cash rate. So they'll generally tack on a little bit more for themselves based on some pretty crude forecasts that I did, assuming that the banks would add, say, like 10% more onto what the RBA would look at. The average mortgage rate, say, in 2 years' time, would probably be closer to 4%. So if you're trying to do your calculations and repayments at the moment, if you're borrowing, say, a $500,000 loan, it wouldn't hurt working out your payments at a 4% just to make sure you're kind of comfortable. And if you're thinking, no, you know what, I want some more stability, then it doesn't hurt. You could potentially fix in for 2 years at sort of 3.5% and have that stability and that sort of knowledge that and that certainty that that's what your payment's going to be for the next little while. I guess overall, like, as inflation is going to bite, Nathan, like, you're probably going to see more rental increases and some of those other costs increasing. So you definitely want to keep a bit of buffer there. Definitely what the RBA has said is over the coming months, important additional evidence will be available to the board. So they're going to be looking at stuff like labour, cost increases, the costs of living, how that goes up. I guess the election is going to make a difference. Some of those tax cuts we covered in our video last week, and how that's going to impact. It's definitely going to impact people. It's going to bite. So it's worth factoring in now. Is it going to affect the market negatively? I don't think so. There was there's a good article actually by Propertyology talking about the previous cash rate changes. They go into the fact that even in previous times that the market has changed and interest rates have gone up, it actually hasn't affected the interest rate rises. So let me just pull up the article here, and I'll share on my screen now. Come with the examples they've got, but it's one checking out. So propertyology.com.au, Simon Priestley is a buyer's agent. He's actually gone full like saying that potentially the median house price in lots of Australian locations could actually double over the next 6 years. So some of this, check it out. He's got some of his research there showing that when in price in the past, when interest rates have increased, property price actually went with it, because it's had the impact and the flow-on effects from rents potentially gone up. So it's meant for landlords it's gone up, and there's been different effects on property prices. We've obviously had no international tourism. People have been saving. Loans have been cheap over the last couple of years, and there's a couple of drags that can kind of slow things down. So check out this article. Pretty interesting to say that he's actually going the other way and saying that high interest rates could lead to more property growth. I think overall, no one has a crystal ball. Kind of to your point earlier, Nathan, you need to sort of run your own race. You need to work out if fixed makes sense, if variable doesn't. What's your kind of parting words there, Nathan?
I think, once again, it comes down to your own individual circumstances. A lot of our clients, we actually look at the spread between the current variable rate versus the fixed rate and where they think rates are going to be at the end of the day. Because look, if you're paying a 1.5% increase on a fixed rate right now and your variable rate's 1.5% lower, you've just kind of got to ask yourself, where do you think rates are going to be over the next 12, 24 months? And how much more are you paying for that stability right now in comparison to where rates are going to go? Because we've said it before, it's very hard to know exactly where things are going to land. So we really work together with our clients to understand where they stand and where they think the market's going to go.
Yeah, because you tend to hit a point. I know for me personally, when I fixed my rates, I think it was like around 2009, 10. Once the RBA starts putting the cash rate up, you kind of miss the point of fixed rates. Like the fixed rates tend to be priced way, way above the variable, because they're kind of looking at what things are going to be in the next 2-3 years. So it's sort of at the point now where it still can make sense for fixed rates, even financially. You need to assess the situation, like Nathan said. If you do need help with that, Hunter Galloway with Home for Home Buyers across Australia. So if you've got an existing loan, you're worried about rates going up, you're worried about your bank potentially putting up those rates in the next few months, it's looking more and more likely. We can assess your current situation, your existing loans. There's no cost for our services. You get paid by the banks. And even if you're a home buyer and you're concerned about what the impact of higher interest rates is going to have on your budget, is going to make you have to cut back on expenses, we can do some modeling and see what's going to make sense in the situation. So we'd definitely love to help you out. So hit us up at huntergalloway.com.au. And what do you think about interest rates? Like it's pretty topical at the moment, especially being an election. Liberals are saying that they're going to keep rates lower. Labor's going to say a different thing. I think over time it's sort of said no one's really had an impact on that. It's up to the RBA and the economy. But what do you guys think? Think rates going to go up, go down, whatever? Would love to hear. Leave a comment below. Until next time, we'll see you guys.